Today we are going to be talking about a very interesting topic called as the corporate action. What we are going to do is understand how certain decisions, certain corporate actions have an impact on the stock price or the overall trading or the way people perceive the stocks. Corporate action. In this topic we are going to talk about what are really corporate actions and the purpose for which they are announced or they are done. We will also look at who are the parties involved, to how to manage a corporate action. We will look at all the stakeholders that are involved in this, the roles and responsibilities. Now largely since we focus on institutional trades, there are a lot of parties who are managing a corporate action, and there is an entire, as such, a life cycle of a corporate action. We will take a look at that as well. We will look at what are the types of corporate actions, and we will look at certain dates. These dates are very important and become extremely crucial in terms of managing the life cycle of a corporate actions. And finally, the entire trade life cycle or a life cycle of a trade when a corporate action is announced, how is it that is managed in particularly an institutional scenario. So let's first try and understand what is a corporate action. A corporate action, as the word itself is suggesting, is any action by the corporate which has a material impact on the securities of the company. Now we can say that there are certain actions which will not have an impact on the securities as such, but what is relevant for our discussion today is any corporate action which will have an impact on the prices of the securities. And I am saying securities here so that we are not just including equities here, but it could be even debt as well. But for the purpose of today's conversation and discussion, we are going to be focusing on corporate actions which have a material impact on the stock price as such. Now there are corporate actions which will have a direct financial impact on the shareholders, right? Or there may be corporate actions which may not have a direct financial impact as such. And we look at, once we look at the examples, I think it's going to be more clearer in terms of what I'm trying to say here. So let's look at some of the corporate actions and why they are done. A lot of times the corporate as such is analyzing, it's contemplating a change in the way the capital is structured. There is a component of equity, there is a component of debt. Due to the earnings being substantial, the corporate may want to reward the shareholders for laying the trust in the company, or use that same reserves to kind of restructure the capital so that the company grows better financially and the balance sheet looks better and so on. So there are very different reasons and purposes for which a corporate action is taken. I've listed some of them here, which is basically distribution of income or restructuring of either the debt or overall capital as such. And finally there could be also increasing or decreasing the capital. Now if you look at it, all of this, the common thing here is the capital part of it. Yeah, if you not talk about, let's say, the dissemination of information to the shareholder, rest all of those are basically to do with capital of the company, which means a direct financial impact on the shareholders or the owners of the company, right? So just to kind of prove the point that any corporate action which will be taken with the idea of having an impact on the capital necessarily means that the stock prices or the stockholders are impacted. What are the types basically? Now we'll broadly classify the corporate actions into three categories: the mandatory with options, and voluntary. Now technically there should be only mandatory and voluntary, but there's one more which is as such mandatory, but there are certain options in terms of what the shareholder would like to choose from the options that are given. We'll look at these in detail, but just to kind of substantiate the points here, in the mandatory corporate action there is no choice as such. The company goes through a corporate action and it's impacting all the shareholders, and there is no choice as such to the shareholder. The stockholder, the shareholder has to go through this corporate action whatsoever. The one which is voluntary, basically, as the word is suggesting, there is a choice. It's basically a choice to the stockholder whether he or she wants to participate in this corporate action or not. And as I had said it earlier, the one which is mandatory but options. So there is a mandatory corporate action as such, but the way the impact is seen or felt is basically through some of the choices that are given, and it's left up to the stockholder or the shareholder to decide which one of the option he or she is choosing. Now let's look at the roles and responsibilities of whenever a corporate action is announced, there are a lot of people impacted, and there are a lot of parties as such that get into the play that actually have a role to play, and this is a very crucial role. And when we look at the life cycle of a corporate action, all of this is going to be very pertinent. But let's just try and understand in the first place who are the parties that are involved in a corporate action and the roles that they play. So first and foremost, of course, is the issuer or the company as such. Now the issuing company, the issuer is always the borrower or the one who has issued rather the security. Now in case of equity, it's the issuing company that is let us say issuing a corporate action or coming up with a corporate action. So first and foremost, they must communicate this decision to the stockholders, the stakeholders, and all the parties that are kind of going to get affected by this. The next is the transfer agent. Now who are the transfer agents basically, or we also call them registrar and transfer agents, or RTA agents and RTA and so on. Now these are the ones, these are the agents who hold the records of who are the shareholders or the stockholders and who will be impacted by the corporate action. Yeah. Now let's say if a stock is getting impacted due to a corporate action, but we must also understand that the stock is being traded on a day-to-day basis, and there is a time lag between the trade that is done on the exchange on a particular day and the actual transfer of ownership from the seller to the buyer. This typically takes about 1 or 2 days, which means that this time lag can cause some sort of a confusion in terms of who is the actual owner of the security, and particularly when there is a corporate action, there will be a dispute in terms of whether the seller is eligible for the corporate action or it's the buyer. So with that in mind, the transfer agent's role becomes extremely important, and so of course there are other parties, everyone's role becomes important, and exchanges, including the exchanges as well. Then there is a fund manager. Now a major part of holdings is with the institutions or the funds as such. So whenever a corporate action takes place, it's the fund manager who has to take a call whether the fund will participate or not participate, and this is particularly true for corporate actions that are voluntary in nature. Yeah, so it's the fund manager as well who will have to take a decision in terms of whether to participate or not. Then there are the custodians as such, and when I say custodians, it includes the global custodians or regional custodians or local custodians, everyone, all the entire custodian community, whoever is impacted because their clients hold the securities. So it's the role of the custodian to manage the corporate action. As such, and we've discussed it in other sessions as well, that a custodian basically takes care of the post-trading activities. So the post-trading activity and maintaining the safekeeping or the records of the securities also means that they will also have to take care of the corporate actions if and when a corporate action is announced. So it's the custodians who will basically manage the entire corporate action event on behalf of their clients, right? And it starts off from, if it's mandatory, then obviously there is no choice. It's something that the client will have to go through anyways. But if it's a voluntary, then it starts off from taking the decision from the client as to whether they would like to participate or not, and accordingly do the processing. So custodians, they basically manage the entire corporate action life cycle, and it's the entire life cycle right from the dissemination of the information the moment a corporate action is announced to the point that the corporate action event is over and the final reconciliations are placed. The reconciliations are kind of in place. So this is the role of the custodian. Now there are some other parties as well. One of the important people who are involved in this are the data vendors. While they are someone who are probably behind the scenes as such, but they are a very important constituent because they are the ones that supply this information. They are the ones that kind of disseminate this information. So agencies like Bloomberg or Reuters or Morningstar, and there are so many others as such, they basically have a repository of the securities, and any corporate action that gets announced, they also kind of manage and maintain a record of each of these corporate action, which forms the basis of further actions by the custodians as such. The regulators and the regulatory authorities, well, of course, given that the entire financial markets or capital markets particularly are regulated, any sort of corporate action, because these corporate action have a material impact on the securities and are likely to impact the investors' interest as such, the regulators will obviously have a role to play in terms of monitoring, in terms of reviewing the various actions, the various announcements, and so on. And finally, the shareholders or the investors, well, they are the ones who are the most impacted as such, because it's their holding. They are the ones who have a beneficial interest in the company, and any sort of material change in the price of the security or any sort of announcement which leads them towards a change in the security price, they will be definitely impacted. So this is basically the set of people who are directly impacted whenever a corporate action is announced. When it comes to the roles and responsibilities, we have to also make a mention about the exchanges as such, because the exchanges, the trading is taking place on the exchanges, whereas the record of who is the owner of the security is maintained by the registrar and the transfer agents. And as I had mentioned earlier, there is a gap because a trade done on day one is settled maybe the next day or the T+2 as such, which means that the price has to be adjusted in case the owner, if let us say the date is on a day but on day 1, and the settlement is going to take place on day 2. So the trade that is done on t minus 1, or the settlement date, has to ensure that the price is adjusted. Let me give you a proper example. Maybe we'll take some fictitious date for this. Now let's say a stock like Bharat Petroleum. I'm just making it up, yeah. So a stock like Bharat Petroleum, and let's say the date is 1st of October, right? And I'm assuming weekdays here, and I don't know about weekends and so on. I'm just assuming as a date. So let's say the date on which it is traded, let us say, is 1st of October, and the date on which the shareholders of Bharat Petroleum will be eligible for dividend is, let's say, 3rd of October. Now, as such, if we say that it's T plus 2, which means the trade done on day 1 will be settled on the 3rd day, which is T plus 2, technically this looks okay as long as there is a settlement happening and the date is taken into consideration. But if the date is 3rd of October and the 2nd of October, let's say, is a bank holiday, right, which means the settlement will actually take place on the 4th of October, which means people who traded on 1st October will not, when I say traded, people who bought the security on 1st of October will become the owner in the books of the company only on 4th of October. But the cutoff was 3rd of October. So they will be at a disadvantage. To ensure that there is no problem there and the buyers are not at a disadvantage, the price on that day is adjusted, which means if you trade on 1st of October, in any case the buyer will not be eligible for the corporate action. So the price of the security is adjusted, and we'll look at that in detail when we talk about the life cycle of the event. These events are called as cum and ex. We'll talk about that as we go along. But what is important here is to note that the exchanges have a very important role to play to ensure that the corporate action is managed well and that no investor interest is actually jeopardized. So then there are, of course, these banks and brokerage firms. These are the parties that are involved, particularly when it comes to corporate actions where there is a cash element involved. When I say cash, I mean money or funds as such. Let's say a dividend. Obviously the money part will have to be handled by the banking system, and hence that makes the banks very integral to this entire corporate action life cycle management as such. Market data providers, as I had mentioned earlier, these are the ones who provide the data. So whenever a corporate action is announced, generally it's the market data providers who have the first-hand information about the corporate actions, and they are the ones who kind of announce it, or who are the ones who actually kind of make it public as such. And even particularly the large players, the institutions, their custodians, the funds, the insurance companies, everybody, they refer for the authenticity of the data and the genuinity of it. They will always go to a market data provider to kind of check the information, and that's the source that they rely on as such. Now let's look at the various types of corporate actions. Let's take some examples. Let's try and understand. We've already talked about mandatory, voluntary, and the mandatory with options. So let's start off with mandatory. So as the words are itself suggesting, mandatory corporate actions are the ones that are mandatory for everybody, and all the stockholders are directly impacted by such a corporate actions. Here are some of the examples, and we'll look at each of these in detail. So it's a bonus issue, there's a stock split, there's a reverse stock split, then there are mergers and acquisitions and the spin-offs. Let's start off with bonus share. Bonus shares are basically free shares, right? So these are announced by the company, of course, post the decision amongst the board of directors. So a bonus issue basically means that additional shares are allotted to the existing shareholders absolutely free. So basically the new shares that people get, the stockholders get, they are not supposed to pay for it. So a bonus issue is not really a fundraising issue. It's simple fact that these are free shares and additional shares are given away to the people who are already the shareholders. So that says it all. So why does a bonus issue happen? Well, the company decides to change the capital by way of distributing or capitalizing the accumulated earnings. Accumulated earnings, basically this is profits, reserves over some years, and the company decides to capitalize this and convert them into, let's say, free shares. Yeah. So the company issues bonus shares with the idea to reward the shareholders as such and increase the equity base as such. A recent example is, of course, Reliance Industries, which is coming up with a 1:1 bonus issue, right? So the idea in a bonus issue is to capitalize the reserves. If you look at from a balance sheet perspective or accounting perspective, you have the reserves, which is all the accumulated profits and the assets that the companies have built in over the years. So when a free share is issued, your reserves will go down and your capital will increase. So you're basically capitalizing the reserves as such, yeah. And these are typically expressed in terms of a ratio. So 1:2, 1:1, 1:3, could be anything. So for every one share that is held by a shareholder, they get one additional share absolutely free, right? So basically, how is it treated in the market? Given the fact that, let us say, and I'll take the recent example, let's say Reliance Industries. If there is an issue which is a bonus issue that's coming up, and shortly there's going to be a cutoff date, a record date for that. So let's say the price of Reliance on that day is, let's say, 2,700, and it's a 1:1 issue, which means if there is a shareholder who is holding one share of Reliance Industries, is eligible for one additional share, right? So today the 2,700 price as such is basically the price of two shares, because the one share is the existing share and the one share is the eligibility as such of the bonus issue. Now let's say the date, the record date passes by. So people who have received the bonus shares, or let's say 1 day prior, it's traded for 2,700. The next day, whoever buys will not be eligible, right? Which means that the earlier day, the price of 2,700, the 2,700 was the price, and it was 1:1, so which means two shares. So the price needs to be adjusted the next day of the record date. So theoretically, and of course practically, the first price that it will get traded on the next day of the record date will be the half of 2,700. Yeah. So basically the price per share is reduced to adjust for the free shares. Here's an example. Well, Infosys has had a fantastic reputation as far as bonus issues are concerned. The company's been issuing bonus shares to its shareholders and rewarding them, be it Infosys, be it TCS. There are so many companies that have a very good record as far as issuing bonus shares to their shareholders. Here's basically let's look at some of the lists of bonus shares that are recently announced. There you see whole lot of companies, they've come up with bonus issues in 2024. We've taken the example of Reliance and there's the record date and the ex bonus date as well. We'll talk about record dates and the ex date when we talk about the corporate action life cycle. So stay with that for a moment, but here's just the list of stocks that have announced bonus in this year. Let's move on. Let's talk about stock split. This is another mandatory corporate action which is very popular as such. Let's understand this well. Stock split basically refers to the split or the reduction of the face value as such. Yeah. So example, let us say if there is a stock, the face value of that stock is 100 rupees, and let's say there are 1 million shares that are floating, that are with the public and that are being traded every day, let's say. Now with the idea of increasing liquidity, now if there are only 1 million shares and each one is 100 shares as a face value, but of course the market price would be different. The 1 million shares that are being traded, yeah, given that there is less number of free float or less number of shares that are being traded on a day-to-day basis, that there will be a lot of volatility or the price movement will be high, because there are the shares are not traded with ease. There are not many people trading every day, just to put it in a very simple terms. So the company decides to split the stock, as in the face value of 100 rupees, let us say, is now made as 10 rupees. Now if let us say I hold 1000 shares where the face value is 100, now 1000 shares of face value 100, so the value is 100,000. Now if the 100 face value is split and made 10 rupees, in order to keep the value intact, my number of shares should increase, right? If I have 1000 shares of 100 rupees each, if 100 rupees share is now made 10 rupees, my 1000 shares should become 10,000 rupees. Or in a very simple way, if I have a 500 rupee note, to kind of have one note of 500 vis-a-vis 10 notes of 50 each, it's the same thing, right? The denomination has changed from 500 to let's say 50, then obviously the number of notes has to be increased. So basically a stock split is a decision taken by the company to increase the liquidity of the stock. The overall market capitalization or the value as such, and we've talked about it, if it's 1000 shares of 100 each, and instead of 1000 into 100, if it's 10,000 into 10, the value doesn't change, the value remains 100,000. So the market capitalization or the value of the shareholders holding does not change. Yeah, so it's just that the face value has been reduced from 100 to a 10, or a 10 to a 5 or a 10 to a 2 or a 10 to 1. There are so many examples available. I recall Hindustan Lever used to be 100 rupee share and became a 10 rupee share, and so on and so on. So there are many examples around that, and this is a mandatory action. Now what it also means is that the face value, let us say, is let's say 10 rupees, and if the price in the market is, let's say, 500, right, then the price also will get adjusted, and because the face value has been reduced. So if the 10 rupee share becomes 1 rupee share, the 500 rupees market value will become 50, as simple as that. I remember Tata Steel is a good example. Tata Steel used to be a share which was about 1200, 1300 rupees. So when the stock split happened, now it's trading at about 130, 140 and so on. So the market price will obviously have to be adjusted because the quantity of the shares has increased. So since the face value is now reduced, the market price will also be adjusted. We've already talked about it, that this is basically a mandatory action, and there is a date, of course, which is pre-decided, and the idea is to ensure that there are more number of shares available for trading. The purpose is to ensure that the liquidity gets better, increase the liquidity of trading, increase the liquidity in the market. Here are some examples. We just now spoke about Tata Steel. The Tata Steel was a 1:10, which means a 10 rupee share became a 1 rupee share and so on. So, and IRB Infra is another example of a stock split. What about reverse stock split? Well, this is self-explanatory as such. So in the case of a stock split, a 10 rupee share became a 1 rupee share. So in reverse split, it is going to be the other way around. It's also called as consolidation. Basically, the idea is if the company wants to kind of do a reverse stock split, basically the number of outstanding shares that are available in the market for trading, the company wants to reduce that. The idea is to kind of ensure that the market cap, which is a very diluted one, there's a lot of trading happening on it, and the company increases the face value, thereby reducing the quantity of shares that are available for trading. That is primarily the reason. Reverse stock splits are not very popular. Hardly you will have some examples there, unlike stock split, which a lot of companies kind of go for. So a reverse stock split basically helps the company to earn investors' confidence. The idea is to consolidate the shares, the face value, let's say, which is 10 rupees, make it 100 rupees, thereby decreasing the number of shares that are floating in the market or being traded. And since the number of shares are consolidated, or the face value is consolidated, the price obviously will have to be adjusted accordingly. In the case of a stock split, we've seen that the number of shares increase, so the price had to be decreased or adjusted accordingly. In the case of consolidation or a reverse stock split, since the face value is increased, the stock price also will have to be adjusted accordingly. This is again a mandatory as such corporate action, which means there is no option for the stock holder or the shareholder as such, and they have to go through this reverse stock split. There's no choice as such. Here are some of the examples of reverse stock split. So General Electric came up with a reverse stock split some years back, and there are these Indian companies, LG Balakrishnan, LS Industries and so on. You won't find many examples of reverse stock split, particularly in comparison to the stock split as such. A lot of companies go through stock split, And if you look at the past few years records, many companies have in fact reduced the face value and gone for a stock split. Most of the companies earlier were either 10 rupees or 100 rupees, and now they are at 2 rupees or 1 rupees or 5 rupees and so on. In fact, some of the companies actually go for have gone for multiple stock split. They've made their stock from, let's say, 100 to 10 and then 10 to 5, or from 10 to 5 and then 5 to 2, and so on and so on. So that's about reverse stock split. Let's talk about mergers and acquisitions. So mergers and acquisitions basically is a corporate action, and let's talk about mergers particularly first. In the case of a merger, it's actually two companies that come together and form a one entity, and kind of combining the business, and then they do business together. Now it's possible that the name of the company, one of the name can be retained. So example, a very popular example, HDFC Bank and HDFC. So HDFC as such was a housing development finance company, and HDFC Bank, as we all know, is a bank. So both of these entities merged, and actually it's now HDFC Bank that's a combined entity, merging the business of HDFC into the banking business as such. Acquisition, on the other hand, is basically a company that acquires another company. Now usually it's a big company, a large company with a great market cap acquiring a smaller company. And there are many examples. In fact, if I'm not mistaken, today's news says Ambuja Cement will acquire Orient Cement. So and there have been some examples in the past as well, particularly in the cement sector. If I'm not mistaken, I think Ultratech is buying out India Cement. So acquisition basically is a corporate action where you have one company buying the other. Now what happens from the shareholders' perspective? Let's say the company that's been acquired, let's say Orient Cement, or Gujarat Ambuja is the acquirer. Now since the post corporate action entity is going to be Gujarat Ambuja, that will remain, the shareholders of Orient Cement will get shares of Gujarat Ambuja Cement. So now post the corporate action, because Orient Cement loses its identity, their business will be merged with Gujarat Ambuja. And frankly, there are variations to this. There are instances where the company that's been acquired retains its entity or does business on its own. So there can be variations to this corporate action as such, and it's really case to case in terms of how the acquirer wants to kind of treat the shareholders post the corporate action, how the balance sheet will look like. Will there be a consolidated balance sheet? Will there be separate balance sheets, or the company that's been acquired will do business independently, and so on and so on. So it's slightly case to case, but conceptually what we're trying to understand here is that in case of mergers and acquisition, it's actually either two companies coming together and becoming one, and in acquisitions it's one large company, a big company actually acquiring a small company, and so on. Spin-off. In the case of a spin-off, it's basically a company that's kind of hiving off one of its business, or even multiple businesses for that matter. So basically there is a company which under its one name is doing multiple businesses, and decides to hive off, spin off, or even sell one of the business or a part of a business to another company. It can even be a subsidiary and so on. So in the case of a spin-off, the parent company's existing shareholder, now before the corporate action, prior to the corporate action, the value of the share included all the divisions of the parent company. So if I hold the share of the parent company, the value of that share includes that small company that's been spun off, right? Which means that if that part of the business is being sold off or treated as a separate entity now, and maybe it's listed independently on the exchanges, it could be anything, but basically it's a mandatory corporate action and the stock price will get impacted, because the price earlier of the parent company included that division's value as well. Now if that value is being separated, the price here will be adjusted accordingly, right? Why do spin-offs happen, or why do people go for it or companies go for it? Well, it's value creation, because you have a company which has its subsidiaries, and the parent company, the shareholder of the company is holding those shares. Now if the subsidiaries, let's say, were spun off and they were listed, then that's a separate value creation, because those again will get traded and their price will go up and increase, which means obviously there is value creation. That's primarily the reason why kind of spin-off takes place. Now let's look at some of the voluntary corporate actions. Now basically voluntary corporate actions are a choice as such. It's basically a choice given to this shareholder whether he wants to participate in that corporate action or not, and that's why the word voluntary. Examples, buybacks and rights issues. Let's talk about these. So buyback basically is a corporate action where the company is repurchasing the shares from the existing shareholders. Now fundamentally an equity share is basically a capital raising act, right, where the company issued the shares to the shareholders and got money from them to conduct business and expand or whatever. Now after years, and when the company does substantially well and has a lot of reserves, the company may choose, because it has cash, because it has funds, it has money, the company may choose to buy back these shares from the shareholders. So the idea is the company wants to now utilize those reserves, that cash, and buy back the shares, as the company believes that doesn't want that much capital, let's say maybe it's actually as such a reduction of capital as such. Example, you had a case, Bajaj Auto was a recent example, right, where the company for a particular period decides, and where the shareholders are advised to tender their shares, right, at a particular price which is better than market price. It's a lucrative proposition always. Otherwise, of course, people will not participate, since this is a voluntary corporate action. So buyback, the issuing company sets a date and says we will buy back shares of a certain maximum limit, right? See, because the question arises, if the company's capital, let's say, is 50,000 crores, I'm giving just an example, and company wants to only buy back 5,000 crores, which is about 10%. So which shares will it buy back? Whose share will it buy back? Right? They have to treat everybody at par. So basically they announce a buyback and set a max limit that they will buy back shares up to a particular limit. And if there are people there are more number of people, if against 5,000 crores, if they have received more number of applications, more people who have tendered the shares, then obviously there is a mechanism to proportionately select and do it on a pro rata basis. But the example here is a company will issue an announcement, will announce that they are buying back the shares. The company will basically announce that it's coming up with a buyback offer of a particular value, and they will set a date where the shareholders are expected to tender their shares, and the company, based on the overall applications, will decide how many they want to buy back from each shareholder, and accordingly, that will be announced to the shareholders. Here are some of the examples. These are basically companies that came up with a buyback in the past few years. Now let's talk about rights issue. So rights, as the word is self-explanatory, it's basically an issue of subscription. It's subscription for new shares, but it's for the people who are already the existing shareholders of the company. So when the company wants to raise capital, it's basically now going to the existing shareholders and not really to the general public. So example, if let's say a company came up with a public issue in 2020 and raised a certain amount, and let's say in 2024 they want to raise further, they want to raise more capital, but instead of coming up with a new follow-on public issue or a new public issue, they want to now go back to the existing shareholders and say, we are willing to buy, we are willing to issue more shares, and if you are willing to buy shares, we can give it to you at a particular price in a particular ratio. So a rights issue basically is raising capital by the company, but from the existing shareholders. The company comes up with this announcement, and the price at which they are willing to kind of sell these shares to the existing shareholders is discounted to the market. So obviously it has to be made attractive for the existing shareholders so that they can subscribe for it. And there is a ratio as well. So they can come up with something like, for every 3 shares that you hold, you can maybe go for 1 share or something like that. So the ratio is decided, the price is decided, which is in most cases is discounted price, of course, and this right is only for the people who are the existing shareholders of the company. And this is voluntary, because if the existing shareholder does not wish to subscribe, then they can actually forego this right as such. There are instances where these rights can also be traded and are also traded and sold in the market. So if a shareholder does not want to go for additional shares, does not want to subscribe for the rights issue, they can actually sell these rights in the market as well, right? But if the shares or the rights are not sold and are not subscribed, then obviously the rights, the shares, the right as such has lapsed as such. Yeah. Here are some of the examples of the rights issues: Suzlon Energy, Reliance. There are many such examples where people have come up with issues, where companies have come up with rights issues and made it very good value proposition for its shareholders. Now let's look at what are mandatory with choice. So basically this is a corporate action where as such the company is coming up with a mandatory corporate action. However, there is an element of choice given to the shareholders. So they have to go through the corporate action, but they can choose between two options, let's say. A very classic example of this is cash or stock options. Basically, in this case, the shareholders are given a choice whether they would like the dividend in the form of cash or in the form of shares. So if we talk about dividend, so dividend is basically distribution of the profit as such. The company's done well and wants to reward its shareholders, so the company declares dividend. Now, if the company gives a choice to the shareholders that instead of taking the dividend in the form of cash, they can actually opt for shares, then that's a mandatory corporate action, but there is an element of choice, cash or shares. Similarly, there is merger where the option is given whether to participate or not. Now this is some sort of a mechanism where the company is basically asking its shareholders whether the company whether they would like to participate in this merger or not. So it's a merger with election as such, because it's a case where the entity as such is retaining its identity, and there can be a choice given to the shareholder whether they want to not participate in this merger. So that's again one of the corporate action, a mandatory corporate action, but with a choice. And similarly, it's the case of spin-off as well. Merger and spin-off, obviously spin-off is the other way around. So it's basically an election, a choice given to the shareholders of the parent corporation. Now, the entire corporate action process as such, or a life cycle of a corporate action event, has some very important dates. And what is important to learn here is the fact that when a company comes up with a corporate action, the benefit goes to the shareholders. Who are the shareholders? The shareholders are the one whose name appears in the register of members. They are the ones who are eligible for the corporate action. The point is, the register of member is a dynamic thing. It keeps changing because every day shares are being traded on the exchange. If the shares are traded on a daily basis, the shareholders are, the names of the shareholders are changing. The register of member is being updated every day. So the question comes, who is the rightful owner, or who is the rightful party to get the benefit of the corporate action? To make that simple, there are certain dates, there are certain norms and processes that are followed. Let's understand these dates first, and then when we talk about the life cycle of events, it will be very clear. So announcement date is the date on which the corporate action is announced. So the company comes up with an announcement. Let's say, for example, the Reliance Industry comes up with an announcement that the company will be giving a 1:1 bonus to its shareholders. That's an announcement date. X date, record date and payment date. Let's talk about X date and record date together. Now, the company has announced that there will be a bonus issue. Who will be the shareholders? Who will be the beneficial shareholders who will get the bonus shares? So the company fixes a date. The company says, whoever is the shareholder, whoever's name appears in the register of members as on a particular date, those shareholders are eligible for the bonus shares. Now, since the register of members is continuously updated, this is a dynamic thing, which means that what if the shares are traded at a particular price, and we've taken this example before, but let me just reiterate that. And let me take a different example. I've already taken Reliance example explaining the bonus. Let's take a different example. Let's say Bharat Petroleum. Let's say the price of Bharat Petroleum shares is, let's say, 340 rupees, example. And the company declares a dividend of 40 rupees. BPCL has a very good track record of declaring good amounts of dividend. So I'll just take this as an example. So the company's stock price is at 340 and the company announces that it is going to give a dividend of 40 rupees. And the record date that has been decided is, let us say, 23rd of October. Now, people who are shareholders who own BPCL shares and their names appear in the register of members as on 23rd of October will get 40 rupees dividend credited to their account. But there are people who may have bought shares just a couple of days prior to 23rd of October, let's say. Now, the buying and selling or the trading happens on the exchange, and it's the clearing house, the settlement system, the settlement corporation at an exchange that actually affects this seller to buyer transfer of securities, and ultimately that is reflected in the register of members, which means if a shareholder has to become the beneficiary of this 40 rupees dividend, the shareholder's name has to appear on 23rd of October. Suppose if the shareholder is buying on 22nd of October, just one day prior to the record date, and the settlement cycle is of 2 days, which means that the shares traded on 22nd of October, people who buy the security on 22nd of October will only become rightful shareholders and whose name will appear in the register of members only on 24th of October. So they will miss this record date and they will not be eligible for this 40 rupees dividend. So if the trade has been done at 340 rupees, which included the 40 rupees dividend, so the buyer has paid 340 rupees and is rightfully or should be getting 40 rupees dividend, but will not become the shareholder in the register of members before the stipulated date. So that's not correct, which means the trade that takes place on 22nd of October, by virtue of the settlement cycle, the new shareholders will anyways not become eligible for the dividend, so they should not be paying for that dividend. So the price has to be adjusted. So people who were eligible until, let's say, 20th or 21st of October will get dividend, so the price is 340. But on 22nd October, because the new shareholders will not get dividend, the price is adjusted and now is being traded, let's say, at 300. This date from which the benefit is not going to be available to the new shareholders is nothing but the X date. X here refers to without. All the trading that took place prior to that included the dividend. So those are cum dates or cum dividend dates. Cum means with, X means without. So until 21st October, the new shareholders would be eligible, so the price is 340. 22nd of October, it will not be eligible, so it's X date, and 23rd is your record date. I hope that explains both the dates well. Yeah. Payment date is the actual date on which the payment is affected. So the record date is taken into consideration. So the company will look at the shareholders register, all those names that are appearing on that particular record date, and all of those shareholders will get the dividend payment depending on the banking system, depending on the way the company is processed the dividends. So the date on which the actual payment is made to the shareholders, that's nothing but your payment date. So we have already talked about the cum entitlement and the X entitlement. Cum always means with, X means without. So basically, before the record date and depending on the settlement cycle, now the settlement cycle again is different in different countries. Some follow a T+2, some follow a T+1, some follow T+3. So depending on the settlement cycle that the exchanges follow, and depending on the record date, once the record date is announced, the exchange will announce the X date. So basically they are saying that since the record date is announced, any share that is traded, and depending on the T+2 or the T+1 cycle, they will say that the trades that will take place from a particular date will be an X benefit or X corporate action date, which means any trades done on that day are not really eligible for the corporate action. Let's look at the entire trade life cycle, and this is primarily from the perspective of institutions, where we've already at the start of the discussion spoken about the custodians, the market data providers, the exchanges, the depositories. All of these entities, these organizations play a very crucial role in the entire life cycle of corporate actions. So let's go one by one and understand the life cycle of a corporate action event. First and foremost is the communication, the announcement as such. So the moment a company announces a corporate action, and we'll take an example, let's say a Reliance bonus issue or a BPCL dividend, could be anything. So it starts off with the announcement of the corporate action, and the first thing that happens is all the market data providers will get that information. There are these companies like a Bloomberg or a Reuters or a Morningstar. They have almost like a real-time data feed coming in, and they publish this information once they have it from the company. So the company announces the corporate action, and the market data providers put it in their system, and that's kind of disseminated to all the custodians, the institutions, and whoever has basically subscribed to that particular market data. Now the next step is the reconciliation aspect of it. This reconciliation basically is to calculate the entitlement. Now whether the corporate action is mandatory or voluntary, that part is still to come, but first and foremost is the entitlement. This is particularly relevant in case of events which have the stock element into it, or where there is a dividend. So if the company is declared a dividend, let's say of 40 rupees, or if it's a Reliance which is a 1:1 bonus issue as such, the institution would like to know from its custodian how much is my holding, what is my entitlement, if there is a dividend coming in, what, because the company has announced it as a per share dividend, what is the amount that is expected, what is the entitlement, or if it's a 1:1 bonus, then what is the holding today, what is the entitlement today. This also means that since the institution is also trading, there will be a lot of trades that are done but not yet settled. So all of this is a matter of reconciliation. But basically the idea is to calculate the entitlement. Once the entitlement is done, since the event could be a mandatory or a voluntary, the event needs to be communicated, the event needs to be basically published, and the institutions or the client organization need to take a call whether they want to participate in this corporate action or not. This is particularly in the case of a voluntary corporate action. Once the decision is made, and let me take two examples simultaneously so we are able to understand the process well. Let's say if it's a dividend, dividend is a mandatory one, so it's only the entitlement and there is no choice as such, or there is no decision that needs to be taken. But if it's a rights issue, then obviously the client has to decide whether it wants to participate in that rights issue or not, whether it wants to subscribe to additional shares, and if so, how many shares they want to subscribe. So one is the entitlement, the other is whether they want to go for it, or they can partly participate or may choose to forego it. So depending on the decision of the client, the custodian or the agent as such needs to process these events. Now given the fact that there are timelines attached to it, and there is a reconciliation aspect to it, in the sense that even the entitlement as such is very dynamic, because let's say the holding on a particular date, let's say, is 100,000 shares, and let me take the example of 23rd October we took as an example. If 23rd October is the record date and the entitlement calculated a few days back, let's say 100,000, but there could be trades that have been done on 21st and 22nd, just 1 day and 2 days prior to the record date as well. The institution, the client, would have either bought some additional shares or sold some additional shares, could be anything. And this is a reconciliation event because the shares could have been bought but may not have yet been credited to the account, which means the holding, though it's showing 100,000 as on date, but there are also some shares which are pending settlement, which means the holding as such is likely to go up. At the same time, there could be shares that have been sold. So though the holding as on date is 100,000, but since, let's say, the company sold 5,000 shares, but they have not yet been actually delivered. So the holding is still showing 100,000, whereas the rightful holding should be 95,000 technically. So all of this is basically a processing, an entitlement calculation, a matter of reconciliation that the custodians or the agents need to do. So once the entitlement is calculated, the agent or the custodian will convey this to the client institution and seek their approval or decision whether they want to participate or not. That's only of course in the case of a voluntary corporate action. But once the approval comes and once it's decided that yes, there will be participation and to what extent, the custodian or the agent has to then process those corporate actions. Basically, if it's a rights issue, they need to apply for the new shares and so on and so on. And accordingly, the money part needs to be handled and so on. Once this is done, the books, the holdings, the depository statements, all of these need to be reconciled and post the event. Now, what is important here is that a reconciliation needs to take place. Basically, a reconciliation is what was expected to happen and what is actually happened. So it's a reconciliation between what was supposed to be done and whether that's been done accordingly or not. So if the entitlement says, let us say 100,000 shares was the holding, and accordingly let's say 1:1 bonus, so 100,000 shares should have been received. But if that number of shares is not 100,000 and there's a discrepancy, obviously that needs to be investigated. What was the reason? Is it because of the shares in transit? Is it because the shares were bought but not received, or whether it was shares were sold but they were not delivered and so on. So all of this is a matter of reconciliation, and once the reconciliation is done and the processing is corrected, the same needs to be reported to the client in terms of the entire corporate action, the eligibility, the entitlement, and finally the credits or whatever shares or amounts were supposed to be received have been received or not. With that, we come to an end to this particular session on corporate actions. Thank you.
Found this session valuable? Hit the like button, subscribe to our channel, and tell us in the comments below what topic we should dive into next.